Hello, welcome back to 𝑽𝑵FXTRADING YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. Okay, in today's video, I'm gonna show you something that will help you profit in the Forex market, and the topic is field/PDF analysis in Forex synthetic market. The PDF here means probability distribution function analysis. Okay, you see, the word field means region in space where there are discrete forces acting to achieve a goal. Okay, the market is something that have to do with the forces of demand and supply at both higher time frame and lower time frames. And the main purpose of this video is to help you manage risk. If you understand the field and PDF characteristics of Forex synthetic market, you will be able to take your profit at the right time. In most cases, some trader will end up losing a winning trade. That this trade actually give you certain profit, but at the end you take loss. This video is addressing the issue. Okay, right now I'm going to show you the intuitive meaning of field. Now let's take, for instance, this is a Forex market. Okay, the circle represents buyers and sellers in the Forex market. Sellers are in this market, buyers are in this market. Okay, now there is not just one seller and there is not just one buyer, but we have infinity of these elements. We have infinity of this element. There are infinity. Okay, these elements are infinite, and so they are interacting. Some make price go up, some make price go down. So sellers make price go down, buyers make price go up, and this creates field and probability, because if price is at this spot, we have binary probability. There is probability it will go down or go up. If price is at this spot, there is probability it will go up or go down. Okay, so because there is this change of direction and there is this probability that direction might change, okay, that's bring the notion of field or PDF analysis, which you are going to use to manage risk. Okay, so this is the little illustration. I'm going deep into the practical part so that this video is not going to take more than 5 minutes. Okay, look at this chart in the 30 minutes time frame and let us run the field analysis. Now we shall be using the arrow diagram, the arrow the arrow element or objects for the field analysis. In advanced studies, you'll be using Fratos to study field analysis. Okay, now you will see the chart as a kind of field, or you can see the chart as a space where there are interactive forces of buy and selling, demand and supply, resistance and support. Okay, market as I jump from one position, from one potential to another potential, it cannot be stationary for some small period of time. It is always changing position, like a kind of state, and we can treat market as a quantum event. So that will be this position and entanglement, and all these things happen. That's why market is complicated and a lot of people find it difficult to make profit. So conventionally, it will be like there are two types of forces, the upward and downward forces, but that is not true. We still have forces that move at different angle of attack, and so we can have horizontal forces as well. and then we have forces acting at certain angle, making price to follow different trajectories. Okay, so when you are tracing these trajectories, you are defining fields and probability distribution function PDF in the Forex synthetic market. And this is what I want to teach here. I've been actually pondering and planning this content for a long period of time, and right here is the result. Okay, so we are going to quantize the probabilities, and when we are making trading decisions, we are putting this into considerations. Okay, and right here you see that here the probability here is about 50%. Okay, the probability here is about 40%. So we have 50 here, we have 4, we pretty much we have, let's get this, we have 40 here. So we have the probability here, we basically, because we have 50% probability for the force to go upwards. Like anywhere you place probability, it have two values. So a probability of an event going to take place is P. The probability that the event is not going to take place is 1 minus P. So this becomes a field, right? So to every potential, to every price is subject to probability, since it cannot remain at that constant value. If the price is, let's say, 2.00, it's not going to be 2.00 for very finite or very small period of time. Even if it is closer to zero, it have to change. It have to change, at tick level, at nanoseconds. Okay, so the quantum state is what is going to take place here. The market is more quantum driven than classical driven, and so right here, when the probability here is 50%, we also have another probability which is also 50%. When the probability here is 40%, we also have another probability which is 60%. Okay, but we can have absolute probability where there is no possibility of an event to happen in another region in the chart, and these are complicated issues. But you being super powerful trader, you should actually deploy this thing to manage risk. I just want to manage risk. I just want to teach you how to deploy field analysis and probability distribution function analysis to manage risk. Okay, so when you deploy, okay, the probability of, okay, look at this level. That is force that are probably going to act in this direction. Generally, the market flow from left to right, so it's assumed that towards the left, if you are going back to left, the forces are zero. If you are going back to right, the forces are infinity. So the forces gradually decreases to zero. That's why you cannot use the past event or historical event to predict the future, because the forces which make the price move are going to reduce back to zero in the left, towards the past, while moving to the right or future, the force is going to increase. So you can't actually use those, you can't actually tell what those forces are going to do based on what happened in the past. That's why the path theory says that what actually control market is what's happening along that path. Okay, that's good, because pretty much if we are going to analyze this market here, and you say because there are reversals here, so the probability here is that we have 70% probability that the market will go up. That is not true. If you have 70% probability that market will go up, we also have 30% probability that it will go down. 30% probability, the value of a probability, the percentage given to a probability, the quantized percentage probability given to an event does not guarantee the energy content of the event. Even 20% possibility that actually become a certainty is enough to make you lose all your money. So that's cool. And so what I'm trying to bring in here is, if we synthesize the sell signal here, S, Okay, you have to make sure you take your profit here because of the probabilities that we are activated. They become activated as price approaches there and are waiting to react. Okay, so it's more realistic to take profit than to end up with a loss. No matter how small the loss is, it's more realistic because you are bringing a very finite capital into an infinite pool of forces that are waiting to absorb those capital. So you dare not play with probabilities, distribution, function analysis, and field characteristics of the market, because these are where your money is going to be faced with war and faced with forces. If those forces are in support of your money, you make more profit, your account grow. If those forces are against your money, you lose money. So the general rule of thumb is take profit where there are probability that you are going to end up in loss. Once that probability is there is difference between zero probability and valued probability. Once a probability have a non-zero value, make sure you take your profit there depending on the time frame of observation. So this time frame, I must definitely take all my profit here. I can use any lot size, but I must take my profit here. If I fail to do that, I will have this profit, let's say $1,000, and this market reverses here, I will end up in negative. I'll be ending this video. Make sure you are proactive. If you have been losing money, I think at this level we never see losses again. Like straight win every week, straight win every day, straight win every month, straight win every year. What you need to do pretty much is to subscribe to our VIP channels, enroll for our courses and mentorship in this Forex synthetic industry, and change your life overnight. Also, you can pretty much become our affiliate, referring a lot of traders who are losing money or who pretty much need super services, super knowledge, who pretty much need to escape a lot of failures. Refer them and you get 30% commission, and for those investing you can get 5% commission on the investment. Imagine an investor investing $1 billion and our company pays you 5%. You are making almost 5% of $1 million is something that can change your life overnight. Okay, because we will actually recover those commissions to our infinite profitable signals. Okay, so if you check 5% of $1 million, you are basically making $50,000, okay, just by referring an investor who is going to invest $1 million and beyond. Okay, thank you and bye for now.